Investor sentiment. Here's the thing. I talked earlier about this cringe element that I have with China stocks or just China period. After years of investors dismissing China as an uninvestable due to policy shifts, weak domestic demand, and geopolitical risks, there are signs of a renewed interest in Chinese equities. Here I am. I guess I'm Exhibit A, I guess. Uh, then it does some differentiation. It does some kind of like pros and cons of each ETF. So the XCH, it's saying the good things about it are it's been around longer. It's not a new ETF. That's kind of like flavor of the monthy. It's been around. Higher liquidity, higher bid-ask tight spreads for better price discovery, lower trading expense ratio, and it has a more large cap exposure. That's brilliant. That's a great overview for me to get a sense of this ETF. Here's the advantages of the China one. Here's the case for it. Much more broader exposure, lower expense ratio, but then when you add all the numbers in, they're almost the same. Access to mainland China listed companies. Okay, that's a different thing. Greater sector diversification, more balanced exposure across sectors. Lower concentration risk. The top 10 holdings represent 30% versus 58%. Brilliant. Brilliant. And so, and at the end, it gives you its take. So both XCH offer Canadian investors, so these are Canadian-based ETFs, exposure to the Chinese equity market, but with different approaches and characteristics. The XCH provides a more concentrated exposure to China's largest companies that are listed in Hong Kong, with higher liquidity, a longer track record, but at a higher expense ratio. China.B offers broad market exposure with significantly more holdings and greater sector diversification at a lower MER, but with higher trading expenses and wider bid-ask spreads.